Hello, this is Chuck Carnevale, co-founder of FastGraphs, aka Mr. Valuation, bringing you another 2-minute drill, Lessons in Valuation subscriber request series. These are videos where I just give you a high-level look at a company based on requests from subscribers asking me to cover the stocks. Today's stock is going to be Adobe. It's an application software company. You can always go into FastGraphs in the external links, go to the company's corporate website and learn about the company you're looking at. I just wanted to point that out. Looking at Adobe here, from just a standpoint of operating earnings, the company pays no dividend. This is purely a growth stock. It had decent growth coming through the recession. Then we had a couple of bad years. But if you look at it for the last 11 years or so, the company's really strung together some great growth. Let's go back to 13 years. Now, I'm doing this for a purpose. You can utilize FastGraphs to evaluate different time frames and evaluate growth. So we've got growth in the 20% range here. If I drop it to 8 years, it's now down to 15%. The more current the time frame, probably the more relevant it is. But by looking at these different time frames, it can help you analyze the stock. Now, in the long run, stock price is going to tend to follow earnings and earnings growth. If I look at Adobe here, you can see when they were going through this first period, it traded around a 15 times earnings. It was a 15.61%. So this orange line is drawn at a 15.61. But again, if I shorten this to an 8-year graph, now we've got 15.79% growth, and the stock is trading at a much higher valuation. The normal PE here has been about 30. Okay, so as you evaluate different time frames, if I go back to 14 years, now the stock is trading at, if I used a 23 multiple, these are things that you have to make a decision on. The stock looks relatively inexpensive, but looking to the future, the company is expected to grow at about 11%, which is very good, but is trading at a premium valuation based on that growth, and it's followed by a lot of companies. It's A+ rated, has modest debt. If the stock keeps getting cheaper, this may be one you want to take a look at pretty soon. For my taste, it's still a little expensive, but it's a really great company starting to trade at a reasonable valuation or get close to it. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs. I hope you enjoyed the video. If you did, give me a like, ring the bell, subscribe to our YouTube channel, and take a look at subscribing to FastGraphs, because you can analyze a stock so efficiently and so quickly with FastGraphs. As an investor in stocks, I couldn't even imagine investing without it. Thanks for watching.